Let's turn our attention back to the roller coaster ride that is the crypto corner. Seems like a daily conversation now here. We saw that big sell-off brought on by regulation concerns, both here in the US and China, but Bitcoin climbing back up above that $37,000 handle today. Ethereum also seeing a bounce back in the session after falling to around 1750 price point on Sunday. Now, some of the rebound we're seeing today helped by a research note out from Goldman Sachs saying Bitcoin is now considered an investable asset. Also, Bridgewater Associates founder Ray Dalio revealing he has taken a position in Bitcoin as well. Let's bring in Garry Tan, Initialized Capital founder and managing partner. Garry, always good to talk to you, especially in the face of some of these volatile moves. I'm curious to just get your thoughts on some of the moves we've seen on the back of these headlines coming out of China. Number one, in a broader crackdown on Bitcoin, which has been in place since 2017, but more recently, that headline coming out on Friday about cracking down on Bitcoin mining.
Yeah, I think that there's some evidence from the mini crash from this weekend around this Chinese regulation on Bitcoin mining activity. And mining is heavily concentrated in China. So one of the things that I've been really tracking on my end is the fact that Ethereum is going to a 2.0 version using proof of stake. So what that means is that instead of using proof of work, which requires an incredible outlay of both capital and energy resources, as Elon Musk pointed out. Ethereum 2.0 is actually going to bring that energy use down by 99%. So it's really just far more efficient. And not only that, the fees that go to miners are actually going to go to people who are staking their ether into the security of the network. So I think that that's going to be a really big shift. I think regulation will continue to evolve over the coming years and months because I think that you're going to see countries like China, perhaps even the United States, consider this technology is not going away. It's durable. It's valuable. And so we want a part of that.
You've highlighted, of course, that a drawdown of 50% or more has happened 6 times before. If you couldn't necessarily stomach the volatility, you wouldn't be invested here. But I wonder what you make of what we have seen over the last week or so in terms of what that says about how much more there is to fall, or whether there is, like you said, another leg up here on catalysts like the energy concerns.
Yeah, I think the big thing for people who are new to crypto right now is that these sort of drawdowns are actually quite common. And I would say that if you look at what the terminology and the memes coming out of the GameStop world of diamond hands, a lot of the people who came up with those terms, they came out of the crypto world. That you have to basically hold on if you believe that the fundamentals of what you're holding continue to hold, even despite a 20 or 50% move. And I think that that's just really, really key for people who are freaking out right now. I totally understand that. And the strangest thing that I've learned about crypto over 5 or 6 of these cycles at this point, I guess this being the 7th, the best time to buy, if you have a very clear thesis about the use case for these things, is actually when there's maximum pain. And so it's incredibly counterintuitive, but I think that's really bled over to how a lot of people are approaching. Earlier you were referring to meme stocks, so it's interesting to see the crypto culture really bleed over to the stock culture.
Garry, last time we talked to you was on the public debut of Coinbase, which, of course, you invested early on. The stock is up today, but, of course, that's kind of traded in tandem with Bitcoin. You mentioned then that it is sort of the Microsoft or early days of Microsoft. It's sort of how you view it right now. A lot of concerns right now about the transaction fee and how reliant the company is, but also some of the competition it now faces from decentralized exchanges. I know it's been only a month or so, but I'm curious how you've been watching the moves and how Coinbase has been trading.
Yeah, I think one way to really look at Coinbase is actually sort of highlighted by my interview on my YouTube channel with Brian Armstrong, the CEO and founder. He ended that interview with a thing that really jumped out at me. He said, we're at 1% along the way of the journey. And, to piggyback on Microsoft, Microsoft has been able to build not just one, but several incredible cash cows on that initial base case, which was actually ability to own MS-DOS on the IBM PC. After that, you had Windows. After that, you had Office. And I think that you're going to see similar, really evolution for the Coinbase business. Just a moment ago, we were talking about the future of proof of stake cryptocurrencies. Other really promising cryptocurrencies that have reached mainnet and are in broad use today include Avalanche token and Solana. I'm paying a lot of attention to those today because proof of stake is the future. And Coinbase, for instance, right before the IPO, actually bought a portfolio company of ours called Bison Trails. And so Bison Trails is turning into the gold standard. If you're a corporation that needs to run a proof of stake node to secure your network, this is really the hosting provider, the most trusted hosting provider. And so looking at some of the other tech giants, if you look at Amazon built one of the most profitable businesses on the planet off of Amazon Web Services. And that was really empowered by their initial sort of toehold and their initial growth from book sales. And so that's sort of the thing that I think will continue to occur with a company like Coinbase. Your initial foothold might be exchange, but when you're talking about a platform that will end up being the on-ramp, the identity, the safe place with compliance, with insured assets, these are all sort of the necessary steps to having the crypto ecosystem that actually touches all the parts of the real world. And that's what put Coinbase into business. That's what Coinbase will use to actually continue to build this crypto ecosystem. I think speculation on the Bitcoin price or the price of various tokens, that's really just noise to me. It's really about the use cases over the next 10 to 20 years.
Garry, obviously, you work very closely with a lot of startups as they look to sort of build out the company and look at their potential path to going public. SPACs have been a very popular way over the last year, but it does feel like the wind has sort of been taken out here, largely because of the SEC increasing its scrutiny on it. A number of EV companies, for example, getting a lot of scrutiny, being investigated now. Is that still a path that you advise for some of the startups that you work closely with, or is that something that you think maybe is one option that's been taken off the table, just given the uncertainty around it?
I think what's really important for retail, but also institutional investors to think about when they're looking at SPACs is who is bringing these SPACs to the world. And, I think the public market doesn't get, going public correct every single time. Very obvious example of this to me is look at Blue Apron versus HelloFresh. I mean, Blue Apron was blessed by quote unquote the capital stack. A lot of really, really prominent growth investors sort of blessed that as the clear winner in the space. And what I've learned as a very early stage investor, having invested in this space, is that often the one that is blessed by the capital stack, actually it's the Blue Apron, right? And Blue Apron never had great economics. I think that there's sort of a sense that if you get the right investors on the way up in the private markets, you might be able to be blessed, but that's bad for the ultimate investor. And so I think the SPAC is actually a very interesting tool for things that we're not necessarily blessed by the powers that be, who says who gets to IPO. And I think that in the end, a lot of these SPACs are really not going to make it. On the other hand, enough will build durable businesses that I'm pretty excited, and I'm still relatively bullish, but you really got to look at who is putting these SPACs together, what's the reputational risk. And I think as that develops, we're going to see more activity and more things that we're actually going to be happy that we have invested in.
How many of those SPACs do you think get filtered out when you talk about sort of being a little more selective? It sounds like you think it's still an attractive option for these companies.
I think it really just depends on how much money you can actually raise, and are you ready to be public? And there are a great number of companies that might actually be ready, that could actually become profitable. And the stack in the pipe option is turning out to be attractive if your competitors that might be the Blue Apron have raised too much money. And I think that that's one pattern that we're starting to track.
We are seeing the yield on the 10-year Treasury note. So pulling back just in the session right now, about 1.6%. Inflation fears still continuing to rattle investors in the market with PCE data, of course, personal consumption expenditures out on Friday. Let's bring in James Bullard. He is, of course, the St. Louis Fed Reserve President. We've also got our very own Brian Cheung joining in on the conversation. President Bullard, it's good to talk to you today. When you look back at the more recent economic data, it really did feel like the CPI number that came out a few weeks ago kind of spooked the market. We've also seen what was really a disappointing jobs number back in April. Walk me through how you're interpreting the data right now as you connect the dots.
Well, I think we are going to see more inflation. That's not really a surprise. I think that maybe the size of that particular report, but that's just one number. So we'll see if the demand really flows through to a lasting increase in inflation, or if this is just temporary. I think it's mostly temporary, but that some of it will flow through to inflation expectations, and that we will get inflation above 2% this year and into 2022.
Hey, Jim, Brian Cheung here. Great to speak with you. Now, we've heard from some of your other colleagues in Dallas and Philadelphia, namely saying that they would like to talk about tapering sooner rather than later. Inflation might be one of the reasons there. And you had a very colorful quote in an appearance last week. You said there's a little bit of an inflation hawk in all of us. If there's an inflation hawk inside you, what is that hawk maybe saying about when is the right time to have those discussions?
Yeah, I mean, I think the inflation hawk aspect is that the big inflation that we saw in the 70s and 80s was very painful for the U.S., and it took a long time to get rid of it. So all the way into the 1990s. So no one wants to replay that experience. But the modern era that we're in now has been characterized by inflation, which is too low relative to our inflation target. And so we're just trying to move inflation a little above target and approach inflation from the our inflation target from the high side instead of from the low side, which is where we've been over the last 10 years. You've also got Japan and Europe mired in negative interest rates. We'd rather stay out of that game.
So it sounds like from that perspective, you're not too worried about having that tapered discussion soon, but do you see maybe a case for modifying the $120 billion a month pace? There's been some suggestion that with the housing market looking hot, maybe you could twist away from mortgage-backed securities and lean more heavily on the U.S. Treasury side of purchases. What do you think about that?
I think there will come a time when we can talk more about changing the parameters of monetary policy. I don't think we should do it when we're still in the pandemic. And I know we're getting closer and closer to the end here with more and more vaccinations every day. And so I think it's tempting to feel like, financial markets always want to look ahead, and that makes perfect sense. They have to price all these assets. But when you're in a crisis, I think you should make sure that you've exited the crisis aspect before you think about changing policy. We're not quite there yet. I think we will get there in the months ahead, and that'll be the time when we can start thinking about altering our asset purchase policy.
So what does that say about your view on the labor market? We know that there's still over 8 million relative to pre-pandemic levels still out of jobs, but would you call it a labor shortage? Because our conversation with the San Francisco Fed president, Mary Daly, she said don't call it that because it's a very interesting dynamic at play. What's the major reason, the top one based off of what you're seeing in and around St. Louis, for people not coming back to the jobs that appear to be out there?
Yeah, the anecdotal evidence is overwhelming that this is a tight labor market, and I think we should look at measures which would corroborate that. Otherwise, you've got this glaring inconsistency between the way we're measuring the labor market and what people are actually saying about it. Firms are saying it's very difficult to hire workers right now. I think if you look at the unemployment to vacancy ratio, that's about a 1.2 today, almost one job opening for every officially unemployed worker. So that makes a lot of sense that it would be hard to find workers in that environment. So it's a much tighter labor market than other measures would suggest. And I think maybe we should look at the U over V as a metric for where we are in labor market tightness.
You also said recently that, when you look at the type of fiscal support that's been available from Congress, you think that the one-size-fits-all approach doesn't necessarily address the divide that we're seeing in the labor market between the rural markets as well as the urban markets, too. Can you talk a bit about how those recoveries are diverging right now, and what is the solution here to address that?
Well, the top off in the unemployment benefits from the federal government was certainly welcome, but these markets are very different. The rural labor market in Kentucky or Mississippi or rural Missouri here is very different from big cities like New York or San Francisco. And so the same numbers might mean different things in different places. So I'd really rather that Congress would calibrate that in a way that would be more attentive to the fact that these labor markets are different, and the pay scales are just different. So you're affecting individual incentives to come back to work differently in these different labor markets, and that's something that firms are very sensitive to. You've got small businesses that have been really down and out during the pandemic. They're now trying to come back in, get their revenue streams back up and running, and they can't find workers. That's a very frustrating thing. That's why we're hearing a lot about this. I'm certainly hearing a lot about this in recent weeks.
Well, this is a fascinating element, too, because part of workers, or rather employers not being able to find workers is whether or not the incentives are matching what these types of people looking for jobs are really trying to get compensated for, especially with the risk of getting the virus still out there. So how are you interpreting wage data from that standpoint? We'll get another employment report covering the month of May next week. Is the data still really noisy, or are you really starting to see anecdotal evidence of wage pressures pushing up, which might actually pass over to overall price inflation as well?
Well, these individual businesses are pretty good at what they do, and so they try to get inventive about attracting workers. They might offer a one-time bonus to take the job. They might offer a bonus to take the job and stay in it for 30 days or 60 days or longer. And they might just go ahead and raise the wage that they're offering on the grounds that they'd probably raise it in the future anyway. So I think you are seeing some of the compensation be better, and certainly that's good news for workers. I think what you alluded to at the beginning of your question, though, is that for a disrupted worker who's at the low end of the wage scale, I'm not sure exactly today if it looks like a really good situation to go back to work, because you've still got residual risk on the pandemic itself, and so they're nervous about that. Maybe they wouldn't get paid all that much more than they used to, so they're maybe thinking it's not that great of a labor market yet. And also, these are very flexible markets where people come in and out all the time. So they might feel like they can just wait 30 days or 60 days or 90 days and these jobs will still be out there. So it's not like if I turn this one down, I won't be able to get another one in the future. I think that's probably not the case. They probably will be able to get those in the future. So from the worker's point of view, it's not clear that everyone wants to just jump back in all of a sudden here. There are plenty of reasons. I forgot to mention daycare. You've also got kids at home still. That's been a big factor through this. So it's not so clear for disrupted workers that they just want to stream back into the job market.
Broadly, I want to switch over to financial stability risks. A lot of questions about the impact of running monetary policy this hot for this long. Do you see any sort of bubbles from your vantage point?
We monitor financial stability very closely. I would say it's higher, instability risks are higher than normal, but still not at an alarming level. I think you'll get a case on all sides of this from people on Wall Street, but we are trying to be very careful, look this over very carefully, and take it on board as a potential risk for the U.S. economy.
How big of a risk does climate change rank when you look at the broader challenges to financial stability? The Fed's already set up these two committees to deal with the impact, but what do you see as the headline risk on the issue of climate?
I think we've moved into the mainstream of central banks by joining the international consortium on this. We're certainly cognizant of the financial stability risks related to climate change, but we're doing risk assessment all the time on all kinds of issues, not just the climate change issue. So this is one in a catalog of possible risk to financial stability going forward. And climate, of course, is a slow-moving object, and so the sense in which it would feed back to financial stability is tougher to trace than it would be for other types of financial stability risks. It might be more observable, risky lending, for instance. So I think we have to take that into account. It's just a different type of risk than others that we have analyzed historically.
And Jim, we can't let you go without asking a question about cryptocurrency, especially given all the volatility in prices over the last week or even before that, well before that. So what are your views on cryptocurrency, its use case right now? And then by extension, how closely have you been watching a lot of the volatility in crypto markets as it regards to the Fed's work on a possible digital dollar?
Yeah, I mean, how long do you have? I mean, I have a slide deck on this that's called Non-Uniform Currency and Exchange Rate Chaos. And a couple of the things that are in there. One is that currency competition is nothing new. Private currency issuance has been addressed historically in monetary theory. Milton Friedman said, if you allow private currency issuance, you'll get all kinds of private currencies being issued. And that's exactly what has happened. We have a couple thousand of these around. Most of them are worthless. Also, I think if the cryptocurrency can facilitate transactions that are difficult to make in conventional currencies, then they will have a purpose and might circulate alongside of the nation-backed currencies. So that's another thing I talk about there. They're also quite volatile, as has been very apparent here in recent days. But the fact that different currencies have volatile exchange rates, that's a fundamental problem in the international monetary order, and it's just that much bigger of a problem for privately issued currencies. But it's even a problem for nation-state type currencies where they trade in a volatile way against each other that seems to be distant from actual movements and fundamentals. So lots of interesting things going on in this space. And of course, the Fed is also looking at a Fed coin. So we've got a lot going on. We're watching this very carefully. And I guess that's in a nutshell, that's where I'm at on this.
Jim, I want to follow on what you just said about how maybe most of these are worthless. Then wouldn't that present sort of some financial stability risks if a lot of people are putting money into this thing and it has a value that goes up a lot? If they try to all liquidate at the same time, might that present some issues with a lot of financial institutions maybe getting involved as well?
Well, we hope that those that are involved know the risks attendant. Of course, anytime any investment that you do can go up, but it can go down as well. And so anybody that's putting a portfolio together has to balance the risk and reward, as always in finance. So I think for the most part, people are going into this with eyes wide open. They're certainly not blind to the idea that this is a volatile area, and I would just encourage everyone to be careful and take the risks on board when you're making any investment.
Some good words to end there. St. Louis Fed President James Bullard, it's great to talk to you.
was a boating boom last year, and as part of our continuing series looking at travel going into the summer season leading up to Memorial Day, I want to bring in Brett McGill. He is the president and CEO of MarineMax, which is a boat and yacht retailer. Good to see you, Brett. Thanks for joining us. There wasn't just a boat boom last year. You continued to see it in the first quarter of this year. Your revenue was up 70%. You guys raised your forecast for the remainder of the year. What, though, is changing in terms of either the quantity or the kinds of boats that your clients are buying? Is there anything that's changing as they head into this summer?
Yeah, Julie, thanks for having me on. It's been a crazy past year for us, and ever since I've been in the business, we've always said, hey, best time is out on the water, making memories with your friends and your family. And boy, this past summer, it was crazy. People were out boating, doing just that. And going into this summer, we haven't seen it slow down. People are still looking forward to that recreation, and the traffic in our stores is big, and our internet traffic is big. People still are looking for boats.
Brett, I'm really interested in the super yacht category, some of the biggest, most expensive boats that you sell. What are some of the most expensive ones you've sold, and who's buying them?
Yeah, well, a little over a year ago, we got into the super yacht business by an acquisition of Fraser and also then Northrop & Johnson. And it allows us to take our customer from where we are selling 80 to 100-foot yachts and then extend them all the way up to 300-plus foot yachts. So we'll sell boats that are $10 million, but there's product out there that's selling for upward of $100 million and maybe even more. So, but our average selling price for all of MarineMax is around $200,000. So it's a very luxurious product.
Brett, what's the lead time like right now? If I want to go get myself a boat for the season, I'm imagining that I'm far too late to be out on the water in the summer of 2021. But what's your supply chain looking like, both with the problems we've seen, globally in supply chains, and also this demand surge you guys have seen?
Yeah, the demand is absolutely incredible, which gives us one of the best backlogs we've ever seen in the retail environment. And so that's a good thing. So it allows us to solve for a different problem, which is, people want to go boating today. And it's summertime up north, and those people are getting ready. Down in Florida, they've been boating. So our lead times are a little longer than normal, but, a lot of the people have a boat, so they're willing to keep what they have until their new boat comes in, 30 or 60 days from now. So, but we do have product in stock. So if a family came in today and wanted to buy a boat, we have that available for them. But it is tight, that's for sure.
Well, and Brett, give us a little bit more color around that, just to follow up on that. It's tight, you're saying, because of the demand issue, but I do wonder if you're having anything happen on the supply chain side as well. Is there any sort of raw material you guys are having trouble sourcing, or that you're seeing your manufacturers, your suppliers having trouble sourcing?
Yeah, it really started back when COVID first hit. Nobody knew what was going on, and then a lot of the manufacturers had to close for safety reasons. And right about that time, demand spiked. So they had trouble just keeping up and getting caught up. Well, then you tack on the demand never dwindled. So that kept the pipeline of customers full. And then now you add, there is some supply chain issues, but we work with some of the best manufacturers in the world, and they're fighting every day to get their hands on product, and they're doing a great job getting this product. But it is causing delays. They're just not insurmountable at the moment.
Brett, you've been in this industry for some time. What are some of your thoughts when you see an Amazon founder, Jeff Bezos, reportedly building a 417-foot super yacht for about $500 million? Why would someone need that much boat?
Well, the first thing I think of is, why did my team get a hold of them and sell them a boat? But beyond that, I think it's relative for everybody. For some people, a 20-foot boat with 3 family members out anchoring up on an island, creating a memory that they last forever, to a yacht like that where you can bring several families and have fishing gear available, diving, snorkeling, touring the world. To each his own. But, we service all customers, and, it's pretty exciting to see what's going on around the world. Our charter business, that we have in the Med has been off, and we're hoping that the Med opens up a little bit more this summer, and that charter business can get some steam. But the charter business elsewhere has done very, very well.
You know, Brett, finally, I am kind of curious about, when people are making a financial decision and they decide to buy a boat, we have been watching the housing numbers quite closely. We've been, of course, talking about housing prices going higher. And I wonder if you're getting any kind of further lift if someone is saying the housing market is too crazy right now, maybe I'll buy a new boat instead. What kind of price appreciation have you seen? Have you seen people making those kinds of decisions as well?
Yeah, we do. I think that, whenever we've talked about, what is our competition, it's recreation. It might be, instead of building a swimming pool this summer, they buy a boat to be out on the water. And so the housing prices and the frenzy that's going on there, I don't know if we can correlate, that directly to us, but our demand has been good. It's really about people doing something close to home with family and friends. And, we have customers that have a home up in Nantucket, and then a home in, Naples. And we have stores in all of those locations. And we see people either taking a big boat back and forth between those locations, or they have several boats in both of the locations where they have homes.
It doesn't suck, as they say. Brett McGill, MarineMax President and CEO. Thanks so much for being here. Really appreciate it.
It has been an important week for investors in Coinbase, with shares being under pressure due to the correction in crypto prices. Goldman Sachs and JP Morgan have come out and defended the company with bullish ratings and price targets. Let's chat more about Coinbase with its CFO, Alesia Haas. Alesia, good to speak with you here this morning. Help investors understand what you're seeing on the platform now so far this quarter compared to what you saw in the first quarter. I mean, crypto prices have been under a lot of pressure, and volatility has certainly picked up.
Ryan, thanks so much for having me today. So, welcome to crypto. I think that those who were new to this space may have underestimated the volatility that we can see in this market, but crypto is volatile. It's been volatile since its founding, and we just have to remember this is a really young industry and a very nascent asset class. So, while we have been seeing a lot of volatility, we've been dealing with this since the very beginning. And the momentum that we're seeing continues. There's a lot of interest in crypto. We shared on our first earnings call just recently that the momentum we saw in Q1 had continued into Q2, and that we're optimistic at this point that we're going to see similar levels of excitement on volume on our platform that we saw in the first quarter.
Hi, Alesia. It's Julie here. So let's say that volatility continues and there are still a lot of users on your platform, but I wonder from a financial perspective how that affects your planning. If you need to raise cash by selling shares, for example, and it's difficult to predict the trajectory of the shares because they track with crypto, for example. So how do you sort of manage around those issues?
We've talked a little bit about this before. We think about running scenarios because our business is inherently difficult to forecast, as you've mentioned. There is a lot of volatility. And so the way that we plan is that we look at ranges of possibilities, ranges of outcomes of how many MTUs are going to transact on the platform. What is their typical volume going to look like? And we plan for scenarios that are up. We plan for scenarios that are down. We look at past performance as a good indicator of what could happen, although we obviously don't have a crystal ball and can't tell you exactly what will happen. And then based on those scenarios, we plan our expenses. We are planning to grow our business for the long term, and we are going to invest in our people and our technology, irregardless of what the revenue cycle is. But when we're making those long-term investments, we're looking at what is the resources that we have on our balance sheet, and can we ensure that we can grow cycle to cycle and not be caught in any potential downturn in a crypto winter that we would not have the resources to continue to grow.
Alesia, a lot of focus at the company on institutions. Where are you at in gaining institutional business on the platform?
Institutions has been a new trend really starting in 2020. So retail was the initial driver of crypto, and back in the time the company was founded, we really started as a retail platform for users to come on and buy and sell Bitcoin. We've seen huge growth in retail, but then more recently, we've seen huge momentum in institutional. Over the last 12 months, we now have seen large asset managers, increasingly corporate treasuries, but also pensions and endowments and insurance companies all start to explore how crypto belongs in their investment allocation. And what I would say to you is it's all corners of the institutional market. And they're coming to Coinbase for our custody offering, that we are one of the largest crypto custodians with over $200 billion in total assets on platform, with over $100 billion devoted to institutions at this time. But we also offer a deep order book in terms of liquidity and the ability to have best X. And so now with the fragmentation of assets trading on so many exchanges and so many market makers, we can find that best price for our users. And we're effectively like their outsourced treasury department to ensure they can find the best pricing in the pairs that they're trading on. And we're really excited about the growth that we're seeing on the institutional side.
You know, Alesia, you kind of referenced towards it there, but I wanted to ask how you guys are thinking about really the boom in DeFi. At least from my vantage point, it seems like the crypto space right now is mostly talking about the opportunity for DeFi exchanges. And I think you guys have said comments to, look, if the space is growing, we're happy to see that growth as well. What are those conversations like, with your institutional clients and just internally as a strategy team?
So DeFi is such an exciting space. As you alluded to, it's grown over the last year to now close to $90 billion in the DeFi markets. Obviously, it's come off a little bit over the last week or so. And for those who are unfamiliar with DeFi, DeFi is decentralized finance. These are peer-to-peer applications like lending or insurance with no intermediaries. They're 24-hour a day, 7-day a week, essentially banks, providing some of the same financial services that you got from a traditional financial institution, but through a smart contract, through pure technology. We're really excited about this growth, and we think first and foremost it's going to open up new doors to consumers. And we think that because these are smaller ticket transaction sizes right now, and so not quite at the size that are serving institutions, but it's such early days that I think that we'll see a lot of growth here, and over time, institutions will come to the DeFi market as well. So Coinbase is trying to make it easier to access DeFi. We're trying to more closely integrate those experiences into the Coinbase platform so users can quickly go from centralized finance to decentralized finance and explore this entire new economy that's developing.
And Alesia, the DeFi is kind of sometimes contrasted with TradFi, which now makes us here at Yahoo Finance feel like boomers for talking about stocks. Do you guys think about that? Do you think about that distinction that way, or to you is it just sort of, well, the world is going towards more digital assets, call them whatever you'd like?
That's how we think about it. We think the world is going so that all forms of value, we're seeing it with NFTs, with art, and with other real world assets, but all forms of value now have the opportunity to be represented digitally through a crypto token. And we want to be the marketplace that you come to explore all of those exciting digital assets.
Alesia, before we let you go on a personal note, you have extensive board experience. You've worked at a lot of large financial institutions. What is it like trying to build a business such as crypto, and which is now a publicly traded business in Coinbase?
It's fun. It's a lot of fun. It moves at a pace that I've never seen in my career. There are more opportunities, more things that you have to conceive out of thin air to basically bring to reality. And I love the challenge. I love the talent that I'm surrounded by. These are some of the smartest people I've had a chance to work with in my career. And I'm really overjoyed that I came over to Coinbase when I did.
Good deal. Well, we look forward to staying in touch with you. Coinbase CFO Alesia Haas, good to see you. Have a great Memorial Day weekend.
Thank you so much.
Welcome back to Yahoo Finance Live. Following in the wake of Coinbase and Squarespace, we got another direct listing today. This time, recruiting company ZipRecruiter going public via direct listing to trade at the New York Stock Exchange. They rang the opening bell earlier today, and an interesting time for a company like that to be going public as companies continue to try and struggle to bring new workers on board. And for more on that and where the company is at, I want to bring on Ian Siegel, ZipRecruiter co-founder and CEO, joining us right now. And Ian, congrats on making it out here. Interesting time. I mean, it's very competitive. There's Career Builder, LinkedIn, Glassdoor. How are you guys differentiating yourself in the in this rebound out of the pandemic now?
Well, first off, thank you for having me. And as far as differentiation, what I would say is, unlike traditional job boards, ZipRecruiter plays the role of an active matchmaker. So we've deployed artificial intelligence to curate jobs for specific job seekers for which they would be a top 10 candidate, highly qualified, and they definitely don't want to miss those opportunities. On the employer side, we actually curate potential candidates for them to review as soon as they post a job, and then they have the option to directly recruit those candidates. Both sides of the marketplace love this approach. It's considered an elevated experience for job seekers who fundamentally hate applying to jobs, but they love getting recruited. That's why ZipRecruiter is the #1 rated employer recruiting app on G2 Crowd and has been the #1 rated job search app on both Android and iOS for the last 4 years.
When you talk about the amount of data there and your ability to match the two sides, certainly you've got a good oversight, a good overview of what the labor market is like right now. What are you seeing in terms of how much pickup there are and where the demands are for the jobs?
Yeah, it's a really interesting labor market right now because fundamentally it's two different stories. For employers, the reopening is here. They are hiring and they are hiring aggressively, but job seekers are still proving reluctant. Whether it's they're waiting for the vaccination rate to reach herd immunity or schools to reopen or stimulus to run out, there is enormous pent-up demand amongst job seekers to get back to work that is currently not being expressed. On top of all these unemployed and underemployed people not searching for work, there's this phenomenon going on right now where a lot of the people who are currently employed who normally would have changed jobs in a healthy economy are choosing to not just shelter in place at home, they're actually sheltering in place at their current place of work. We think the back half of this year and the first part of next year, there is going to be an avalanche of job seekers moving in the market, which means that today, right now, is the best time if you're a job seeker to go search, because you're going to want to beat out all that competition that's coming.
Yeah, in regards to your competition, I wonder what that might mean for profitability here in the first quarter. You guys notched profits at $9.5 million. Current quarter guiding forecasts of adjusted EBITDA loss of $16 to $22 million. Talk to me about maybe the demand to see among shareholders to see profitability now at a time like this when there's intense need to get new employees through the door.
Well, what I would say about ZipRecruiter now and for the long term is that we are a profitable company. We intend to stay profitable. The Q2 story is impacted by this process that we're going through and the one-time costs associated with it. But we're an extremely healthy business. We have a highly repeatable business model, and we definitely think that we're going to be good stewards of capital as we go forward. And interestingly enough, we have more money in the bank right now than we've ever raised in primary capital. So we have a lot of dry powder, and we have clear runway in front of us as we grow.
So how do you put that capital to use? How do you expand your platform?
Well, we have a number of different ways, but the key #1 thing that we're doing right now is recruiting more talent. The artificial intelligence that we've deployed isn't just cutting edge, it's bleeding edge. And there is a dogfight for people who have aptitude in this category. We have R&D centers in the US and R&D centers in Israel as we go tap some of the best engineers in the world to keep optimizing what we're doing, and the results are telling. 4 years ago, it took 39 days to fill a job on ZipRecruiter. Today, with that AI matchmaker playing that role of introducer, of a matchmaker between the two sides, that's down to 16 days.
Just kind of more data there around how intense some of this job seeking is there at a time that's all very hot. But Ian Siegel, ZipRecruiter co-founder and CEO, appreciate you taking the time here to chat. Congrats again on the listing down there at the New York Stock Exchange. Welcome back to Yahoo Finance Live in our IPO Power Hour. Today we got another company seeing a big boom in sales during the pandemic, making its debut today. That would be direct-to-consumer scrubs company Figs, the company which boasts the largest DTC platform in healthcare apparel. It's making its debut at the New York Stock Exchange under the Figs ticker symbol. Price shares at $22 in their IPO. That was above the $19 price originally floated by the company. And join us now for more on the debut of Figs are the co-CEOs of Figs here, Heather Hasson and Trina joining us right now alongside Yahoo Finance's Julia LaRoche. And guys, congrats on the debut. Heather, I guess we can start with you here. I mean, we could talk about the exploding revenue that you guys saw, or we could talk about the fact that you guys are a profitable company and adjusted EBITDA $69.1 million last year, up from just $1.7 million in 2019. What are you attributing that growth to? Obviously, the pandemic weighing heavy here, but what kind of excitement are you seeing from your customers now?
Thank you so much for having us today. We're super excited to be here. The growth is really from delivering on the greatest product possible for our healthcare community And it's about, really celebrating the healthcare community. So that's what we do the best. We are the company that stands for healthcare professionals, and we're going to continue to build our brand. We're going to continue to, penetrate the hearts and the minds of the most incredible people, as we like to call them, awesome humans in the world. And I believe that the best companies focus on their people.
And Trina, it's Julie LaRoche here. One of the figures that really stood out to me in the company prospectus was the customer acquisition cost, which you all said decreased by 61% from just a couple of years ago, going from $101 in 2018 to just $39 in 2020. So when we talk about direct to consumer, it's all about that customer acquisition cost. How are you all able to do that? Take us inside that playbook.
Yeah, so at Figs, we really feel like we built the brand the right way. It's been a decade in the making to get to where we are today. And, it's really about focusing both online and offline in really authentic ways, connecting with this community that Heather just talked about, our healthcare professionals, our healthcare community. I think a lot of digitally native direct-to-consumer companies focus on spending to acquire that next customer. And for us, it was always just about building authentic connections, real relationships, both online and offline. And so I think that's what's really driven our CAC down, to your point, 61% over the last 2 years.
And Heather, as Zack was referencing earlier, just the growth that you all saw in revenue, another stat that stood out, that 13% of your styles on your platform account for 82% of your net revenues. So talk to us about the approach here when it comes to innovation. I see that you all have this great core. I would imagine you get a lot of interesting data from your customers when you want to create a new product. So walk us through how that works for you all.
Sure. So before Figs, scrub was considered literally, a V-neck top and a pair of pants. And what we did is we really recreated what scrubs are. And we have our core silhouettes. We also have our limited edition styles in scrubwear. And then we also have our lifestyle products, which outfit the healthcare professional from head to toe, on shift and off shift. We create, our on-shift fleeces. We create our on-shift jackets. And I think we're the only company who creates jackets for the inside for a hospital that's, temperatures are on the average of 62 to 65 degrees Fahrenheit at all times. But, that's how we think about, building out our categories. We're going to go really deep into those categories I just mentioned. Compression socks. We did a great partnership with New Balance, so shoes, underscrubs, all the way out to outerwear.
Yeah, and Trina, I know little about healthcare, not a doctor. I know even less about fashion. So let me ask you this question because, it seems like the trends have shifted. As you guys noted in your S1, 85% of all medical professionals now purchasing their own uniforms. Not entirely sure what was behind that, but when you think about the growth this company has in front of it, I don't know if it's going to double every year in terms of top line because of the pandemic, and we know that. But nursing, doctors, healthcare, a growing industry. So how do you see the growth forecasted for the next couple of years here at Figs?
So we've grown the business every year over 100% since we founded the company in 2013. We did grow during the pandemic 140% year over year. But this was all, the trajectory that we were on was before the pandemic, and we look to continue on this trajectory post the pandemic. But I think, it's really back to creating great products that people love and building a brand that people connect with. And we believe direct to consumer, going direct online to healthcare professionals is the right way to do it. Why were they having to go to these strip malls in the middle of nowhere to find their uniforms? So we really built a solution around product and around delivery. We have the best e-commerce experience in the world.
And speaking of best in the world, you all are expanding internationally. Do you have to take a different approach when it comes to going into different countries? Do you see different trends, different ways that healthcare professionals procure their uniforms?
So we are in 3 countries outside the US today. We are in UK, Australia, and Canada. We look to enter new markets over time, but it is to your point about creating a localized experience. From the currency to the language to the way in which you receive our products in a very fast period of time. And then the e-commerce experience, right? how you're engaging that's really aligned with the culture you're working in, the healthcare institution you're in. That's different around the world. So we'll look to create really localized experiences for our healthcare professionals around the world. And there are millions of healthcare professionals around the world, and we're so excited to bring figs to them.
Yeah, and they all need scrubs. That's an important thing to clarify there. They need those. But thanks for coming on, guys. Congrats again on the debut. Heather Hasson and Trina Spear, FIG's co-CEOs, alongside Yahoo Finance's Julie LaRoche.